Hi there, this is Lauren from militaryplanners.com, and this is our basic accounting workshop. Now, I know there are lots of military spouses and even some service members out there who have their own home businesses, and I hope this presentation gives you just a smidge of what to expect for your accounting needs when you go into business for yourself. As for those of you who aren't military affiliated, we won't hold that against you. All of the same principles apply. So let's get started before my kids wake up. The first thing I want to talk about in today's workshop is the topic that I think we can all agree stresses us out the most, and that is taxes. Now, to determine how complicated your taxes are going to be, I want you to first ask yourself the question, who am I? Or what is your filing status? Are you a sole proprietor, a partnership, a corporation? Sole proprietors are going to have it very easy. All you need to do is include a Schedule C with your personal tax return, and what that'll have on it is spaces for you to fill out your income and your expenses, and then you'll put your net income back on your 1040. A partnership is going to be a little more complicated because you're going to have to fill out just one more form, which is Form 1065, and that will state the total income and expenses for the business. And then each partner will include a Schedule K1 with their personal tax returns, and that will state their share of all the income and expenses and basically be just like a Schedule C. For both sole proprietors and partnerships, if you file using a program like TaxSlayer, which is what I use, or TurboTax, then they'll have prompts for you to fill all of these items out. Now, if your business is advanced enough to be a corporation, I don't think I'm out of line. Just recommending that you seek a little professional help to not only make sure that you do things correctly and legally on your end, but also to make sure that you are able to take full advantage of that status. Now, there are a few special tax issues to being self-employed, and the first one is the self-employment tax. If you make more than $400 per year net of your expenses, you're going to have to pay this. Normally, or if you were employed by someone else, then your employer would pay half of your Social Security and Medicare taxes. But as a self-employed person, you're so lucky that you get to pay all of them. But the bright side is that you get to deduct half of this self-employment tax on your tax return. So you pay it, and then you get a little bit of it back. The second issue is estimated quarterly tax payments. And these are required, you're required to make these if you're expected to owe more than $1,000 in taxes at the end of the year. And now you're probably asking yourself, how the heck am I supposed to know if I'm going to have to pay that? And a good way of guessing, or a good way of estimating whether you're going to have to, is if you make less than $89,000 a year total, and your business makes less than $4,000, you probably aren't going to have to pay it. But if you want to be sure, you can go online, and I'll include the link at the end of this video. You want to just go fill out a Form 1040-ES, and that'll help you make an estimate of whether or not you're going to have to pay these. Moving on to deductions, first thing I want to talk about is I want you to, if you're just starting out, something that's going to keep your life really simple is just making sure you use cash basis accounting. And this is a little foreign way of saying that you only recognize an expense if the cash is out of your account and out of your hands, and vice versa for income. And the reason you're going to want to do this is right now you might, if you're just starting out especially, you might not have that many transactions and you think you can remember, oh, so-and-so owes me this at the end of the year, and so-and-so I owe and so that merchandise. But as your business grows and as your transactions increase, then it's going to get much, much more complicated. And so if you just remember this basic rule, then you're going to start things off so much more simply. Now, moving on to deductions like business mileage and your home office and all that, I think if they're valid deductions, then you should claim them confidently. Don't worry about the IRS, but do save everything that you possibly can, receipts, bank statements, mileage logs, all that paperwork, so that you can keep your books clean and easy to follow. And so if the IRS comes back to audit you, which just happens sometimes, it doesn't mean anything about whether you should or shouldn't claim things. But say they ask you, hey, I noticed you claim a lot of mileage. You can say, yeah, I do, and here is my mileage log and all my receipts to prove it, and they'll be fine with that. Now for the second portion of this short workshop, I want you to ask yourself, what am I made of? For those of you with financial statements who make them, you should be able to answer this question very easily. For me, financial statements are the difference between a hobby and a business. It means you're keeping track of your assets, you're keeping track of your income and your expenses, and you're able to evaluate how your company's doing. And now the first statement I want to go over is called the balance sheet, which I didn't label on this slide for some reason. But the equation of the balance sheet goes like this: assets minus liabilities equals equity. And it's always in balance because it's math. So for assets, you've got your cash, your inventory, supplies, equipment, anything that you use to do your daily business. For your liabilities, I'm sure you all know this, but it's just money that you owe or product that you owe somebody. Say somebody paid you, but you haven't yet delivered on that product. That's a liability to you. And then the last part is equity, which is money that you've invested in your business and money that your business has earned, which is your net income. We're going to go over that on the income statement in a little bit. So I want to run through a couple examples to help you solidify this concept in your mind. So let's say you have $100 in cash in your assets. Where could that cash have come from? Well, you could have either borrowed it, so it would be either a liability, or you could have invested it from your own personal accounts, which would be equity. So see how the equation would always be in balance. If it was a liability, $100 in assets minus $100 in liabilities equals $0 in equity. Or if it was equity, $100 in an asset minus $0 in liability would equal $100 in equity. See, it's always in balance, and that should make you feel really good. Now the next statement I want to go over is the income statement. It's very exciting because it tells you exactly how your business did for any period of time. For those of you with tangible products that you sell, your first lines on the income statement need to be sales minus cost of goods sold equals gross profit. Those of you who sell services aren't going to have a cost of goods sold, which is a very complicated way of saying what it costs to make your product. Now, it might not be inherently obvious, so I want to go over this. A lot of people think that if you go buy, say your business is making necklaces, if you go buy beads to make necklaces, that you should get to deduct them right away as an expense, and that's not the case. You only get to deduct the cost of goods sold when you have sold the product. So you would only deduct, say it takes half a bag of beads to make one necklace. And so you sold a $10 necklace and it cost you $5 to make it, and then your gross profit would be $5. Then after your gross profit, you'll deduct all of your other expenses like advertising and mileage and employee expenses. Now that's another thing that I want to go over, and that's the difference between salaried versus hourly. If you're just getting in business, you're not paying yourself hourly, you're likely paying yourself a salary, and that salary is dependent on whether or not your business makes money. If you have employees who sell things for you on an hourly basis, then you would deduct those. But you can't deduct your time in the business. You can only deduct what you pay yourself. And that's important to remember. I know the last 10 minutes have left you with a lot to ponder, so before I let that simmer, just a couple of recommendations for actually getting things done and accomplishing your financial goals for your business. My first recommendation goes in the spirit of keeping things simple, and that is creating a separate business account. And that'll just help you out at the end of every month, quarter, year. When you go to look at all your transactions, you won't have to sift through them and try and remember what was personal and what was business related. And the second thing I'd recommend is, especially for those of you starting out, a simple Excel spreadsheet should be more than sufficient to keep track of all your financial transactions, your assets, your liabilities, your income, and your expenses. And if Excel intimidates you a little bit, keep an eye on militaryplanners.com, because in the coming weeks we'll be having some templates available for you to use. And as your business grows, you can move from Excel to a program like QuickBooks, which is a really simple, easy program to use, or you could just go ahead and pay an accountant to do it and leave your focus on other parts of your business that are more important to you. So I hope you found today's workshop informative and helpful, and if you have any questions, shoot me an email at lauren@militaryplanners.com or find us on Facebook or Twitter.